Good afternoon, all Inderes TV viewers and listeners, and welcome to Inderes Consumer Night. My name is Thomas Westerholm, and I work as an equity analyst at Inderes, and I'll be working as the host for tonight. I'll start off tonight with a short keynote presentation about consumer goods companies as investment opportunities, which will be followed by two presentations from both Orthex and Rapala. After both presentations, we'll organize short Q&A sessions with the CEOs of both companies. So if you have any questions, please feel free to submit them on the chat and we'll cover them later on. But on to the topic. To start off the topic, I thought about we could start off thinking about the consumer goods space we have here in Finland. We could basically cut it in half, approaching consumer staples companies and consumer discretionary. Consumer staples are usually things you spend or use, consume on a daily basis, like food, drinks, toothpaste, etc. And these are typically have a rather stable demand. Consumer discretionary, on the other hand, are things like clothing, scissors, storing boxes, all the way up to something like new boats, for example. These tend to be more cyclical by nature, but obviously there's big differences between these different kind of products due to their varying sizes and price points. But if we think about what consumer staples companies we have out there, we have beverage manufacturers like Olevi, fish farming in the form of Fifax, meat production from both Atria and HK Foods, plant-based food producers like Appetit and Raisio, ready-to-eat meals and snacks such as Fodelia, wine and spirits like Anora. Moving on to consumer discretionary, we have clothing, bags and accessories producers like Marimekko, fireplace producer Tulikivi, fishing equipment by Rapala, which we'll be presenting later on tonight, home and storage solutions such as Orthex, who will also be producing or presenting today, indoor, outdoor living in the form of Fiskars. We have the sauna company Harvia, and even Tulikivi to a smaller extent, and tire manufacturer Nokia Renkaat as investment opportunities here in the Helsinki Stock Exchange. Things to like about consumer companies as investment opportunities include their diversified customer portfolios. Usually, they're not too reliant on a single customer, but also they tend to come with geographical diversification. So the investor is not too reliant on the development of one single market. Also, strong brands usually enable excess returns, and these companies tend to be rather profitable. The industry also comes with entry barriers. I mean, a strong brand is not easy to replicate, and if you want to start producing something on a bigger volume, it requires quite a lot of upfront investments. But as an analyst, one thing I also like to highlight is that it's rather fun to get to know these products. And it's also straightforward, as we as consumers can just walk to the store, buy these things, try them out, and see if we think it's something enjoyable and worth our money. But moving on, I think we should take a look at the value chain of a typical consumer product company. First off, you have the producer, which faces the decision, should you produce the good by yourself or outsource production? Both of our presenters today produce some of their goods themselves, but also to some extent have outsourced production. These are decisions management has to make based on what's more profitable for the company, because always producing something by yourself isn't the winning strategy. Then, which part of the value chain are you active in? Do you sell your goods via wholesalers and distributors, which usually enables you to get more volume on your sales? Do you utilize retails, or do you go direct to the consumer? This direct-to-consumer trend has been growing in the past 10 years, partly with the advent of growing online sales. And a good example of this trend could be auto manufacturers, where with the agency model, more and more these producers try to be active towards the consumer and sell more and more directly to them. Two good examples here may be Tesla and Polestar, for example. But when thinking about these companies as an investment opportunity, there are some demand drivers you should keep an eye on to, foresee and forecast future development. Consumer purchasing power is probably the most relevant here. It's after all what fuels consumer spending. This has a positive effect on both discretionary spend and also staples. Although usually when purchasing power increases or decreases more, it has a stronger effect on the more discretionary of spend. But even with consumer staples, you might see consumers downshifting or shifting down in some product categories to cheaper private label alternatives, for example. Consumer confidence is also a key variable to keep in mind, and it's usually a solid indicator of future demand of especially bigger discretionary purchases. Here, good examples are autos, fireplaces, and also boats, for example. And the third is interest rates, which usually affects especially these bigger ticket items. Sure, if households have a lot of debt, increasing interest rates might hurt them that way, and from that point of view, affect the consumer purchasing power. But especially the bigger ticket items, such as cars and boats, which are financed using debt, tend to be more sensitive to these interest rates. Here on the right side, I've tried to visualize how, usually as the price of a good goes up, the cyclicality of demands tends to go up as well. This is only illustrative, so don't get too hung up on this graph. But I'm trying to bring out a point here that it's not linear all the way. At some point, there seems to be a kink in this development, as especially luxury goods, think about Ferrari's cars, for example, tend to be have rather stable demand. So even though they are more expensive, the demand tends to be stable here, which makes luxury goods providing an exception to this rule. But when thinking about this as an investment opportunity, you should also think about where are we in this current earnings cycle. Here on the left side, I've indexed our consumer discretionary products companies' stock price performance. I left out the consumer staples in order to free up some space here. But as you can see, as I alluded to earlier, you can even see here that the bigger ticket items, producers of bigger ticket items such as Harvia and Tulikivi, their stock price performance has been more volatile here. You think about the year 2020 and 2021, where consumers saved up a lot, couldn't travel, and demand shifted towards goods. This obviously is reflected in the stock price development of these companies, but it also later on led to a situation where consumers cut back a lot on their product spend or spend on physical goods, where you can see that a lot of these companies' stock prices came down quite a bit after that. But you shouldn't always just look at the stock prices. On the right side, I've even included the EV sales ratio of these companies. It's a trailing 12-month figure in order to get as much data as possible. Here you can see where the expectations have risen of these companies. In the middle of 2021, a lot of these on a per sales basis had rather lofty valuations. In other words, investors were ready to pay more of these companies per euro or dollar of revenues they did. And later on, they have come down quite a bit. Here you can see some optimism creep into some of the names. For example, Harvia has risen rather rapidly as of late. Even Marimekko, the expectations toward that company has come up to a certain extent. But I don't feel like you should give up on the other names with more flattish development, because this may be an indication of a coiled spring. In other words, when these companies' valuations have come down, they also have more of a potential to come up later on if expectations towards them increase going forward. But what to look for in a consumer goods company? Usually a strong brand that resonates with consumers. Strong brands provide pricing power, but some brands are really known, but the consumer isn't willing to pay a premium for them. You should be careful of these companies, as, well, to a certain extent you can question the fact that is the brand really that strong if it doesn't provide the company with pricing power. Economies of scale and scope. If the company produces its own products, how efficient is it and at what rate does it utilize its capacity? If the company has a lot of spare capacity, growth may be very profitable due to operating leverage. And also, if the company produces a lot and has a long history in it, its manufacturing plants may be way more efficient than some competitors. Also, balance sheet strength. A company needs a solid balance sheet in order for its management to be able to focus all of their efforts towards growth and driving shareholder value. And sales and marketing capabilities. These are really essential. Even if the product is superior, you're gonna have to need capable salespeople to really drive that demand. But that's it for my behalf. I'd like to thank you.